This computer. Okay, great. So, hi everybody in the future who's watching the recording. Um, so I'm excited to do our sub-industry spotlight today with Julie Sharp, who's going to talk to us about tax credits and affordable housing and maybe how you can make money in affordable housing. I remember doing a panel with you like many years ago now. It's crazy how time flies, but that
Yeah,
Shreya Singh, our board member and alumni, connected us, and you're very passionate about just because you're in affordable housing doesn't mean you're not like making money and making moves and, being a big part of the deal. So could you tell the people on the call a little bit about who you are and what you do?
yeah. Thanks. I'm Julie Sharp, Executive Vice President at Merchants Capital. Merchants Capital is an $18 billion bank, but really we're an agency lender. So we originate real estate loans on behalf of HUD, Fannie, and Freddie Mac. And then I started in 2020 our tax credit equity division. Typically, if you've looked at affordable housing capital stacks, a lot of it is monetizable tax credits, which we can kind of get into, and then also some sort of agency takeout. And traditionally, merchants had only ever been able to do kind of construction loans and agency takeouts, and standalone syndicators were coming in and doing equity. And so when I launched the platform in 2020, it gave us the ability to kind of come do every aspect of the capital stack in affordable housing. So since then, my team has grown to 50 people in 5 years. Our offices have expanded at Merchants. We have a big office in Chicago, which is where obviously we meet Kelsey. And then we also have offices in New York, Washington, D.C. We're headquartered in Indianapolis, where I sit, and then Minneapolis, St. Paul, and Boston. I'm excited to talk with you all about LIHTC and what it is. It's not an easy topic to people to grasp, but it's a great industry, and I'd love to talk to any of you if you're interested in getting involved.
Yeah, that's amazing. And I haven't heard it laid out like that before, Julie. And like, I'm excited to ask you more questions about even just organization building too, because I think that's so important and what's something a lot of the scholars would be interested in. But, before you wanted to be an EVP in tax credit syndication, what did you want to be when you grew up?
So I read this question and I know you're getting at it's like a career, but I'm going to tell you the honest thing is that I wanted to be rich when I grew up. That was what I wanted to be. My parents both worked in the public sector. My dad was a firefighter for like 30 years. And so I was like, you know what? I want to be rich someday, which is a good mindset to have. But in doing that, like I thought I had to be, an attorney or an
Mm,
accountant. Turns out the real money is not in those things, although they are very meaningful careers and there's a lot of money in them. I think that the bigger side is, upside is on the business side and honestly real estate. And so when I decided that I had an accounting degree and an economics degree, I thought I was going to be a CPA, and I thought that was
mm.
the way that you did it until I kind of got into real estate sectors. And I was like, oh no, like those are people that rich people hire. And so I ended up going into real estate, and we can talk a little bit more about, what my career path exactly looked like. But I found it and loved it and have grown it from there. And I think it's just very interesting when the deals that you're doing are such big numbers. It's, that's kind of how you kind of build those, that book and that portfolio of sales when you're dealing with very large numbers.
Well, I think you're speaking the Goldie Wolf Miller language, which is that she, wants Goldie scholars to be rich too. She wants
Yeah,
women to make more money. She wants them in the corner office, and she doesn't think there's anything wrong with talking about wanting money.
no,
Where I think
no,
a lot of Goldie scholars would be like, "Oh, I don't know, maybe," but she's like, "No, just go for it. You should want that for yourself."
right.
Um, and so we'll keep on getting into it, but I do like to ask this question every time of maybe when you're in an elevator and you're trying to tell someone like what it is that you do in like a really basic terms, some people on the call are here because they kind of know what you do, but some people might be here because they have no idea what you do. So how do you explain your work?
Yeah, so I'm going to give you the slightly longer elevator pitch, just to kind of give you some backstory on what the low-income housing tax credit is. And we also do, solar tax credits, historic tax credits, those types of monetizable tax credits. But it really started with the tax bill of 1986. It was a Reagan-led program. But what Reagan did and what they did in the 80s was they wanted to use the tax code to really incentivize behavior. And so at the time, there was this negative connotation around affordable housing, the projects. And keep in mind, in the 70s and the 80s, that was really, when the government was in the landlord business, right? And we know when the government does anything, they don't do it well. And so a lot of these projects had fell into disrepair. They were costing taxpayers a lot of money to sustain, and people were living in, frankly, horrible living conditions. And so what the Tax Reform Bill of 86 did is, hey, we're going to incentivize private developers to develop affordable housing. And the way that they did it was through the creation of these monetizable tax credits. The LIHTC was the first one, and then it followed with, historic and solar and other behaviors the government wanted to kind of incentivize through a monetizable tax credit. And so what it does is it shifts the production of affordable housing and oversight of affordable housing into the private sector by saying, if you are related, we'll pick on our friend Shreya here, who we do many deals with. She's one of my larger clients. Related is, I think, maybe the largest owner of affordable housing in the United States. They would go in and say, typically, when you build a market rate, deal at Related, you're getting your return on your investment for constructing that affordable or that multifamily housing by cash flow. So you're incentivized to maximize your rents as high as possible because that's how they're going to get the return for building multifamily housing. What the LIHTC does is it says, hey, Related, we know that you can't get a great return by increasing rents because then it would be totally unaffordable. And what we're going to do is we're going to give you a tax credit. So on a $30 million deal that they're going to build, maybe that's 60 units of affordable housing or 100 units of affordable housing, we're going to give you 15 million in tax credits that then you can sell. That money comes in and infuses it into your project, and then you're going to earn a developer fee. But in exchange, you have to cap rents at a certain level, and you can only allow tenants to live there at various income bands. So either 80% of the area median income all the way down to 30% of the area median income. They can only qualify to live there. You're going to get the equity in your project, and so they can essentially do a equity-free deal because we are, bringing an investor in to place that. And then they develop their project, they earn a huge developer fee, and at the end of the 15-year compliance period of when they have to keep rents affordable, sometimes it's longer, they revert back to ownership of that project. So it makes a lot of sense for developers to do it. What I do is I come in and partner with developers once they've received an award of tax credits, once they've kind of have some of their approvals in place, they have a scope, they say, hey, we have 15 million of tax credits. I buy them and I go and I pool them together in investment funds and we sell them to the big banks, insurance companies, large Fortune 500s, any really widely held C Corp that has enormous tax liability that can come in, and I structure a 99.99% limited partner ownership position in a Related deal. Related would be the 0.01 GP. And at the end of the 15 years, when they're claiming their tax, when my investors claiming our tax credit, our fund exits. And now, Related buys us out, and now Related owns the deal free and clear. And so it's a really kind of interesting dynamic. We do a lot of kind of mission-based deals with a lot of local nonprofits, but then we're pooling them together. We're managing risk. We're diversifying locations. And we're selling those to a lot of the big banks. My background before I started the platform is in the capital raising side. So I was the one interfacing with investors, building the investment funds, and then kind of, sourcing in tax credit equity into these deals.
Amazing. I will just do a quick pause. And does that make sense to everybody? Does anyone have any questions just on about the history of tax credits or what Julie does?
I have a quick question, Kelsey.
Yeah, go for it.
Becky, hold on.
Let's see where
Sorry, I was in my car, but I'm not anymore. Hi, Julie. I had a question about what you just said in relation to when you said that at the end of the 15-year period, and the example that you gave with related, that they buy you out. What do you actually
Mhm.
mean by that? Is that um, just perfunctory, or is there an actual cash transaction?
Yeah, so that's a great question. This is actually one of the bigger hot topic items in how the federal government chose to set up this program because, and this is a big misconception I get all the time, is like, well, we're just buying tax credits. And I'm like, well, we're not. We're buying 99.99% ownership position in a multifamily deal that's generating tax credits. So not only are we taking 99% of the tax credits, we're also taking 99.99% of all the income, which typically is tax losses that are accretive to our investor because there's depreciation expenses. And any cash flow during that period, because the IRS has said you have to be a partner in a real estate deal in order to be allocated these tax credits. And that's why we have to do these through partnerships to determine partner status. Well, there's been a lot of litigation in the space on the tax side because it's like, hey, if you don't have downside risk, meaning if I had Shreya say, hey, I'm going to give you $1 million to exit my deal free and clear in 10 years. Well, now I have no downside risk because now the IRS would say you're actually not allowed to claim any of the tax credits because you're not a partner in the deal because you only have upside risk. And so the way that the back end language is structured, and this is kind of an art, with some of the more sophisticated developers like Related, is they try to minimize the amount of back-end value that our investors can take when we exit because they need to buy us out at fair market value of our interest. And so that can become really tricky because they might be really incentivized of like, hey, we only want to do this deal if we think we can recoup all this money on the back end once you exit. So we structure it as fair market value. But what sophisticated developers can go in and do, and what we work with tax counsel to structure is like, hey, your fair market value can be, the appraiser has to take into consideration the fact that you're a limited partner with no powers. It has to take into consideration a 30-year affordability period that you have to keep those rents low. All of these things. There might be sources we structure in the deal that are soft debt that have balloon payments at the end that are kind of eating up any cash that makes my back end interest worthless, which is okay. And so those are all things we try to think about up front. So one, the IRS doesn't audit us and say, you guys aren't a partner, you can't claim any of the deal. But two, we're just really pricing in the tax benefits and not any residual back end value. We are also incentivized to make sure that Related is incentivized to do the deal and we can minimize it as much as possible.
Got it. Okay. Thank you. Appreciate the explanation. Thank you.
Yep.
I have a question. Hi, Julie. I'm Teresa Amaro. Can you explain what downside risk and upside means?
Sure. So there's been a lot of IRS tax law that says if you're going to be a partner in the deal and allocated, certain tax items, then you need to have upside and downside risk. Meaning, if you're making that investment, you need to have the ability to make money, but you also need to have the ability to lose money. And so there's been some landmark court cases in this space. This was actually a historic deal, but the one that comes to mind is like a historic boardwalk case where the IRS basically said there used to be a big thing in pre-0809 where like AIG would guarantee tax credit yields to big institutional investors. And the IRS came in and audited it and said, because AIG has guaranteed your yield to you, you have no downside risk, and therefore all the credits are disallowed. So that in that particular case, like that investor lost $50 million on an investment because the IRS said all the credits you claimed are invalid because you had no downside risk because your yield was guaranteed. And in the space that doesn't work. Now there's all sorts of guaranteed products you can do, but they're not relying on special allocations of tax benefits to achieve them. And so that's why this industry is so interesting. There's lots of different ways in which, tax law intersects with it, but also, the underlying real estate is kind of interesting to structure.
And then one more question. Did you graduate high school and college and say that I'm going to do real estate?
I thought I was going to be a CPA. I went and I decided that I just like couldn't do it. Like I didn't really like the audit side of it. And so what I ended up doing is I went and worked for the brokerage agency Colliers, and I worked as the research analyst on that. I thought it was interesting to kind of look at the time it wasn't affordable or even multifamily, but it was in Indianapolis. Industrial is a big real estate sector here. And so I was pricing in, some real estate investments on industrial buildings in Indianapolis, assisting a broker doing that. And the broker was like, hey, like you can come on and be an industrial broker, but you have to work all commission. I was 22. I had no money. I had student loans. So I was like, well, I can't do that. And so I ended up finding a boutique equity shop that did this. And I started working in underwriting. I did that for a year. Pretty much the way that it works in some of these affordable housing circles is like, go to underwriting or asset management first so you can kind of learn the fundamentals of the real estate and the transactions. But then if you have like a person, like an outgoing personality, you'll easily get recruited into kind of the production roles. And so I went into the investor relations role where I started structuring the funds, and then did that for a standalone equity syndicator for like 7 years. And I was like, I could probably do this myself, and then launched the platform. And here we are. And we've done $3 billion of equity investments in the last 5 years.
Thank you. Thank you. Interesting. Thanks.
Is it fair or maybe it's unfair to CPAs, but like also you're just fun, Julie. You're too fun to be a CPA.
That's what I said, Yeah, I mean, CPA, I do highly recommend accounting, even for like a master's. It's great training and I use it all the time. So I do love the accounting degree still, but just being a CPA was not for me.
Yeah. I am going to let one more scholar ask her question because she has to drop a little early and looks like a good question. So Tiffany, do you want to share?
Yeah. Hi, Julie. Thank you so much for taking the time. My question is really related to, I'm writing a paper right now with an accounting professor, speaking towards like how we could potentially have government be landlords again. And I'm using Cabrini Green in Chicago almost as a case study to see like what went wrong with that initial process. And I wanted to hear or just see some of your like gut reaction to if we were to have government be landlords again, almost having them as a capitalization partner in the sense where because of these light tech tax credits take so long for dense urban cities like New York, I'm from New York, just to even read and review, like I was talking to the Department of Buildings. He said by the time that they see a project, it's usually like it's going to take 7 to 8 years just to move forward. So seeing how governments can potentially even have the capitalization for social housing and having it almost like they can think about it like a infrastructure project, almost as in toll roads or roads, infrastructure, bridges, understanding how that might work, and also maybe having the private developer come in and having richer economics when it comes to like property management and operations. Do you have a thought when it comes to just hearing the idea?
Yeah, so I would love to set up time with you to convince you that the government should not be in the landlord business and all the things that could go wrong. And I think Related owns Cabrini Green now or was looking at it. I know I looked at it to finance it potentially with tax credits. And so we could talk about that specifically, but also, New York is one of the larger markets. I just did a $200 million deal in the Bronx. That's going to be 700 units. Like at some point we'll talk about how that works. But I will say, are you talking about the federal government or the state government or the local government?
That's a great question. I was talking about it from the state government.
Okay. So that's the beauty of the LIHTC program and why it's been so successful, because what it does is it's a federal tax credit that's administered by the state. And so, and that was kind of the beauty of what Reagan did in this structure, and why it enjoys so much support now on a bipartisan basis, is because it really says, hey, the credit is based on a per person or per capita. If New York has 50 million residents, you get $7 per resident, and that's your allocation of tax credits. What it does, there's two types. There's a 4% tax credit, which is used with tax exempt bond allocations. So to your point earlier about like, hey, can state governments look at it as an infrastructure projects? That's exactly what's happening in New York, is where you're allocating, in every state, they're allocating private activity bonds, and that's an automatic qualifier for tax credits. So as long as you get an allocation of private activity bonds, and you're meeting your affordability requirements, then you automatically qualify for the LIHTC credit. It's unlimited, subject to the bond cap. The 9% credit is typically more deeply affordable, more supportive housing, more homeless housing. Those tend to be, those are the competitive tax credits in which, the state still allocates those. And so what they publish, every couple of years, every state, is what it's called a qualified allocation plan. I'm not sure if you've looked at those, but it's kind of going to outline that state's priorities of what they want to see. So in New York, it might be like, hey, we want to see some veterans housing. We want to see some supportive housing. And I will say specific in New York City, the chairman of my New York office used to run the public allocating agency in New York City. So if you're there and you want to meet him, I'm sure he would meet you. And he's on Mamdani's transition committee now, talking through housing and all of that. But they really, state governments and local governments are very involved in LIHTC projects. But to your point, it does take a long time to put these sources together, particularly in a place like New York. But some of that's kind of unavoidable. It's like you have to get extreme environmental reviews, and figuring out how to address environmental issues. The permitting tends to be kind of the worst part. So there isn't really a way to expedite it by having any more government involvement. Typically what I see is the more government involvement, the longer it takes. So the places that it takes the longest to get affordable housing off the ground are New York, Massachusetts, California, all the ones that want to be super involved, because you have to wrap in all of those agencies and neighborhood associations and all of that. So I would say be careful what you wish for on more government involvement. It's going to take longer, but they do take a long time.
I think I was more so speaking towards if I'm the qualified allocation plan, it's harder for younger or smaller, newer developers to come in because they request so much of a track record. So it's hard to prove that out on your own. And then I think to what you were saying, I think with a lot of affordable housing, there's 15 different capital partners for your equity and for your debt. And it's sometimes if you use CDFIs, it's a ton of syndications of clubhouse deals. And so thinking through if a government entity were to just be one partner with one reporting platform, I thought that would be a little bit more easier. But I will definitely message you after to chat through this, because I'm very eager to pick your brain.
So you are right. There's a high barrier to entry, particularly for minority developers and for women. If you look at the top developers of affordable housing in the United States, they are not, diverse like the residents, right? And so a lot of that, though, is, based on the investors, frankly. The investors aren't going to purchase ownership positions and credits without substantial guarantor liquidity and net worth and substantial years of experience. And so what we've worked with investors to try to address, and I personally financed several of these projects, is we try to get, L&M is a great example in New York. If anyone's familiar with L&M development, they're a big client. They'll bring in minority partners into deals to get them development experience that they need while they're providing the guarantor support. They're doing all the heavy lifting of getting permitting and all of those things. But it gives them a track record. It gives them connections with the people that are financing the deals like me and some of our investors. And that way, when they bring us a deal on their own, it's much easier to say yes, because we can underwrite all the prior history. And so that's something investors have been very cognizant of, is how do we get more young people in the space, more diversity in the space? But it is certainly an uphill battle, just given where capital requirements are these days. But yeah, happy to chat with you. I agree, the amount of sources in the deals are a big problem. It's something that we hear all the time. Ironically, the tax bill that was passed in 2025 did have a large expansion to the LIHTC credit. And so our hope is that there's a lot more tax credits available on these deals, so you can kind of eliminate the 15 soft sources that are involved. But that comes with new challenges that I'm dealing with now of if you introduce a huge supply of tax credits and demand is fixed, then it tanks pricing. And you would be shocked at how many members of Congress do not understand basic supply-demand economics. And that's what we're educating members of Congress on
now. Okay. Thank you, Julie, for that answer. And thank you, Tiffany. I know you got to hop, so I'm going to remove Spotlight. Julie, how did you learn all of this? Like, this is so much information and knowledge that you're obviously like an expert on, that doesn't happen overnight, but how'd you learn all this? Just being in it?
Just like trial by fire, right? You find something that's interesting to you and you just learn everything that you can about it. And also, like, I have a really great team. I think that was one of the benefits, when I built my own, is like I relied on a lot of people where I don't know how to, all the people I manage on my team, half of them, I don't know how to do their job. If they were like, hey, you have to lead asset management, I would have no idea. So it's like relying on your team members and getting experts in the right place and being okay with delegating and have them teach you, how to do that. I think that I'm a big proponent of like a team effort, rather than, trying to know everything about everything.
Yeah, completely. And so was it a big challenge to make your own group within Merchants Capital, to make the tax credit syndication platform? And I mean, talk to us about that jump from maybe doing something that you knew how to do, just doing something that you maybe were more unfamiliar with, of building a team of 50 people over 5 years and doing these huge deals. How was that feeling?
It was horrible. Like when I left, so I was at my firm for 8 years, but I had spent a lot of time in investor relations, and so like I really knew the ins and outs of the platform and like who to talk to, because I was selling the entire platform to investors, and so I knew how it was supposed to look and feel to investors, and so that was a good advantage. But when I went to quit, like my boss was pissed, and he's the CEO of the firm now, and he, I don't think he's talked to me since when I quit. And so I came to Merchants, I knew it was the right path though. It was a bigger balance sheet for me, which made it easier. It had the debt component that I didn't have, so I could do kind of a one-stop shop financing execution. I knew it was the right move, but my first day in the office was March 16th of 2020. And for all of us COVID babies, we remember that was the day that the world shut down. And so I got there, I had 3 kids. My youngest kid was 9 months old.
Oh my gosh.
I had 2 other kids under 5. So I had 3 children I had to provide for. And I was like, I have just ruined my life. They're like, go home. I'm like, go home and do what? I have no team. I have no clients. I have no financing model. Like I had to build the model from scratch. It was awful. But I think, and this is one of the things I want to kind of impress upon young people is, you got to just rely on your network. And so, what I did is I called all of my friends in the industry that I had worked with, and now a lot of them work here with me. A lot of like my executive management team on our 50-person platform, like 8 of the 10 executive managers, I have a prior working relationship at CREA, where we were kind of the young people at CREA doing all the work, my old firm, doing all the work, knew the context, knew how it was supposed to look, had kind of gone through building a platform there, and now just having to recreate it here. And so they came over, and it's been great because we are all like in our 30s and 40s, whereas most firms that are our competitors, all of their executive management are like in their 60s. And so when you're selling 15-year term investments to investment banks, you would much rather have somebody in their late 30s managing that investment than someone in their late 60s. There's that continuity of ownership that you can be sure that it's like, hey, in 15 years when we're unwinding this, it's going to be me you're talking to. It's not going to be, whoever bought us out after we retire. So I think there's some advantages in us being young. And now that we've kind of developed such a good track record, the gamble really paid off, but it was a huge gamble at the time.
Oh my gosh, yeah. I was that thought did cross my mind when you and other people are talking about these like 15-year deals. I'm like, 15 years from now, who will we even be?
Yeah.
That's like some person I don't even know anymore. Like, but do you feel like there's just a confidence in different firms that like that those people will still be there's like kind of loyalty and longevity in for the most part versus other sub-industries that maybe like hop around a lot?
Yeah, I mean, it's the tax credit funds perform better than AAA bonds in terms of risk. So,
Mm.
like, there have been exactly zero foreclosures on LIHTC affordable deals in the last 5 years. And so I think the riskiest part for any investor is like from, closing until like the deal stabilizes, until construction's complete and it's leased up with qualifying affordable tenants. Once that happens, the tax credits start flowing. And there's really a very, very small risk of any kind of recapture situation that I described earlier. So I think that gives investors a lot of comfort is like, hey, we're really getting through the first 3 or 4 years. And then after that, the deals are pretty much perfunctory at that point. But it is like a concern. And it's one of the biggest selling points that we, harp on for our platform is like, we have that, we're young, we're publicly traded. So that's the other thing. A lot of people, in 1986, when this program was developed, it was like a lot of guys that just started these shops alone and they still owned them. So we are publicly traded. It's like, hey, you're not going to have to worry about us selling out and cashing out and going to live on our yacht. We're publicly traded. We already have an out. You know who you're getting. So.
Yeah. Everyone here should add Julie on LinkedIn, and I think it's your header. That's you when the IPO, like ringing the bell at Wall Street. Is that
Yeah.
right?
We rang the bell a couple years ago, not the IPO, but it was like celebrate. We were the best performing bank in the United States in 2022, which is funny because like we're a bank, but like we're mortgage bankers that bought a bank that then facilitate our real estate loans. So like we're not like a true bank. So that's why we did so well. But they had us come out to the NASDAQ and close it down. It was really awesome.
Amazing. What was that like?
It was really cool. Super fun. Like on a billboard in Times Square. It was wild. My daughter, ironically, is 10, but she was 8 at the time, and we were doing a girls' weekend in New York City. So I sent her the picture of like me, like on the Times Square NASDAQ billboard, and she was like, "My mom is famous." She thinks it's like there all the time. She's like, my mom is famous.
Yeah, she's pretty cool.
Yeah.
And I'm looking at my questions on my other screen, and I see my one about technology. How do you feel about the rise of AI and, I mean, tech in general, of course, but I feel like we can't go 5 minutes without talking about AI. Like, have you seen that touch into your business yet, or is your part of commercial real estate maybe not quite affected by it quite yet?
So, I mean, not really. Like, it's funny because if you ask AI to do any kind of like tax questions, they like inevitably get it wrong. And so
yeah.
I feel like I'm not too worried about AI replacing anything yet. I don't find a lot of ways to use it efficiently. For me and for this industry that I'm in, it's all about relationships. And I just think that's something that technology can't. You need people to trust you. Not only do you need the developers like related to trust you, because they're putting a lot of trust in you too, because as a limited partner in these deals, I can kick them out for cause. I can say you missed your reporting and therefore I'm taking the whole project. Like all sorts of ways, like you could really, people could act in bad faith in some of these real estate deals. And so you have to have a strong relationship. You have to have a track record. We mentioned all the sources and deals and how things can go wrong. I mean, you really need collaborative partners, even after the deals close, and to sit down with the city and say, look, like this is the situation. We need you to come in with some subsidy or something else to kind of make sure this housing stays affordable. So like you need that trust with people. And it really is about those relationships of like, hey, I'm going to need you on this one. And so I think that's something that just technology can't replace. And again, I will stress that to the folks on the call is like, I'm like a firm believer. I'm in the office 5 days a week. I'm a firm believer of being in the office. I don't think it needs to be all 5, but I could have never started the platform that I did without the relationships that I formed in my 20s with other analysts at my old firm, because now they all work on my team. Like I probably have 30 of them that were at my prior firm that are on my team. And so like those relationships are forged, you know, in your 20s when you're like working until 9 o'clock and you're like, can we order dinner, or getting lunch, or crying under your desk, you know? And it's like now like you tap those later. And so you can't do that if you're not like present with people or interacting. So that again is going to be my advice, is like build those early and then rely on them your entire career.
Love it. So, you know, I have a question here about hard and soft skills, and you've already mentioned, like you just said, the great relationship building and going through some shit with your coworkers, you know, is
Yeah.
bonding, right? And then you said earlier about like the value of the hard skills of like being a CPA, you know, having accounting skills and finance skills. A lot of scholars are, you know, going to grad school, sometimes when you're pivoting your career or you're pivoting your job, when you're looking at applicants for roles, like what are you looking for in maybe people in their 20s and 30s coming to work for you?
So like eye contact is really big for me, just kind of being able to be conversational. I mean, like you're really looking for like, who would I want to have a beer with or a coffee with, you know, afterwards. And like, it really is like that. It's like, and I used to have a boss that would say that the test was like, if I'm stuck in an airport with you at 9 p.m. for 4 hours on a delayed flight, like, do I want to be stuck in an airport with you?
Yeah.
I mean, like that would be the test. And so I would say like, it's, you know, you don't have to be super outgoing. Like a lot of the people that run our numbers are not, they don't want to be on the sales side at all, but it's more just like, hey, do you feel like this is somebody that they're going to tell you the truth, even when it's hard. And they're going to be somebody that you can kind of rely on and talk to and are easygoing. I have like a great story of a woman on my team. You know her. She was a former Goldie mentor, Linda Hill. We've done panels for the Goldie Initiative in the past, but Linda ran the platform at Aegon Transamerica in San Francisco. And she hired a gentleman, and there it's like really corporate. She was hiring an analyst. You know, someone on her team had interviewed this guy. He was a Cal Berkeley guy, came in and was working on Linda's team. And Linda, on the first day, you know, came into his office, like, all right, these are the things I want you to do. Left the office. She gets a text message from the kid. And he said, I would prefer that you do not speak to me in person. Like, I would prefer to communicate via text message. And so she comes out. She's like, yeah, this ain't going to work. You know, you talk to me. And he picked up his stuff and left.
Wow.
I mean, it's shocking to me, some of the younger generation, like how much they don't really like to interact, you know, in person. So if you can do that, you're going to have a leg up for 90% of the candidates that people talk to.
Yeah. Well, I love that. Because you can have a beer with me. I don't know if I could do all the hard skills you need me to, Julie, but I'm good to have a beer with.
Yes, you are.
Kira, can I unmute you or highlight you? You raised your hand. Let's see.
Yeah, yeah, I guess to kind of piggyback off of that question, I'm interested in pivoting into the LIHTC equity industry. So I'm wondering if you could speak a little to how underwriting is different on the LIHTC equity side versus the lending side.
Yeah, so it is very different. I mean, you're still looking at NOI, net operating income. So we're underwriting rents, expenses. On the debt side, they're relying more on appraisals. Whereas on the equity side, we're relying more on a market study, which is like a little bit different to kind of come up with our comps. We're looking at a lot of historic information on the operation side, but we're also looking at some deal structure issues. So our underwriters are all former Ernst & Young, partners that ran the consulting group. And so a good friend of mine runs it. She's looking at a lot of the tax structuring as well as some of like the hard deal things. Whereas on the debt side, they don't care. They're more looking at like, hey, can you make a debt service coverage payment? And so it's a lot more in depth, I would say, on the equity side, because again, you're buying an ownership interest in the partnership, not just can this loan get paid off type situation.
Thank you.
Does that answer your question?
No, that definitely.
And you know, yeah. So Ayana on my team works for the GSEs. She's in DC. She worked at, in lending forever. And then I kind of brought her over on equity. So she's like a dual threat, knows debt and equity. And so she's a great resource too. So if anyone's interested in like what the agency debt looks like, I'm happy to set you up with Ayana. And so she can kind of give you like what equity and debt look like. I will tell you, you make a lot of money on the investor relations side on equity. The people that make the most money are the agency debt originators. So I will just throw that out there. There is huge upside in agency debt originations.
Mm-hmm. It's funny because I'm actually meeting with Ayana today. I have a virtual call with her.
Oh,
so
good.
I'll tell her that you shouted her out. My second question is around pricing competitiveness right now. I'm wondering what you're seeing, and if you're seeing higher developer demand now that the 25% test is in effect.
So we're seeing a lot of deals from developers and really terrible tax credit pricing, because what's happened, and again, this is what I was getting at on the expansion, is like the supply of tax credits went way up through this tax bill. But the pool of investors has stayed the same and almost gotten a little bit smaller because of some of the things that the Trump administration has chosen to do. So in my space, 80% of the tax credit investors is about a $30 billion market on equity investments. About 80% of that market comes from banks that are investing to satisfy Community Reinvestment Act requirements. The Community Reinvestment Act was passed in the 70s. It was intended to combat redlining that the banks were doing. And so what it says is like you need to invest in certain asset types. If we're going to provide you FDIC insurance, you have to invest in communities in which you're accepting deposits. And so the LIHTC is a great way that banks satisfy that requirement. So they're very active in the space. What the Trump administration has done is they have gutted all of the bank regulating agencies to the point that, CIBC is a big client. Like CIBC will say, hey, like our CRA cycle, it's typically a 3-year cycle. The bank regulators will come in and say, hey, you've satisfied your investment test. Their exams keep getting pushed out because there aren't enough bank regulators to come in and doing it. And so what it's kind of doing is like, hey, we kind of need to wait and see where our regulators come in at before we can put out more capital. And so because the regulators aren't there to look at community development investments as the banks are making, like they're not getting done. And so that's been a really unfortunate part because we have this huge supply of tax credits. We have investors that don't want to do it. The big active investors, the economic investors like Goldman, are coming in like, oh, well, we're going to do pricing for, we're going to pay you 75 cents per dollar of tax credit, which is really low. It's, been as high as $1. It's been, as low as 50 cents right after the program, but 75 is like a 10 penny drop from what we were seeing a year ago. So it's making the deals much harder to pencil, meaning we have to go back to the states and say, you got to put in more subsidy, or developers have to basically give away a lot of their economics up front to kind of make the deals work. So it's getting really hard. Capital is getting scarcer. And we talked about what happens when capital gets scarce. Investors there's a flight to quality, right? So you're like, hey, I want to do the deal with Related because they have $1 billion of cash. I don't want to do the nonprofit minority developer that doesn't have as much experience, that doesn't have, the balance sheet necessarily. And so that's a really unfortunate consequence, is like the deals that get financed are the big major players because there's this flight to quality and when capital is scarce. And so it's really unfortunate to see some of those smaller deals that are really impactful in communities not be able to find financing.
I love that perspective. Thank you so much. If you see me looking down, I'm taking notes. But my last question is around sourcing new fund investors. I know you spoke a lot about like existing relationships and how you were kind of able to bring those investors over into your new job. But I'm wondering, what are the approaches to finding new investors? Is it cold calling? I'm just wondering. Yeah.
So
good question.
You guys will laugh, but like JP Morgan is my largest investor. My second largest investor was someone I never worked with that we cold called, and it is the Sherwin-Williams Paint Company out of Cleveland. And I joke, and I'm dead serious, I am probably the largest grossing paint salesman for Sherwin-Williams in the United States. They have done 300 million of tax credit deals with us, including 2 we're doing in downtown Chicago right now that are super cool. We should look at them sometime. We'll take a field trip, Kelsey. But 111 West Monroe, right above the JW, that's going to be a historic LIHTC market rate mixed use project. And then 208 South LaSalle, both kind of in that CBD in Chicago. Those are Sherwin-Williams deals in which Sherwin-Williams is going to do $80 million of historic credits, tax credits that we've sourced for them. The developer here, Prime Development, who's building Google's headquarters, they're the sponsor on that. They're going to use Sherwin-Williams paint products. So like any deal Sherwin does, we require their paint products on the deal, which is really lucrative for them. The margin on paint is like 90%, by the way. I like know all this stuff about paint now. And so we do a lot of business with them. Related is a very large Sherwin-Williams paint customer because they have 100,000 units, all over. And so when I want to do, we did 10 deals with Related in Ohio that Sherwin-Williams ended up buying because we were like, hey, Related spends, $2 million a year in Sherwin-Williams paint. And they're like, okay, we'll do their deals. So that was a cold call. And that was a developer that we were working with in North Carolina that was going to do a new paint contract with PPG. And he was like, yeah, like, I wonder if we should call Sherwin and see if they'll buy my deals if we do the paint contract. And then they were like, yeah, we'll do that. And that's kind of how it started. And now we've done all these really cool deals with them. So we've done that. We did it with a steel company, Steel Dynamics, massive publicly traded company in Fort Wayne, Indiana, that, there was a deal. It was really hard to get financed. It was a mixed income deal, had a lot of market rate units, which the traditional LIHTC investors don't love. And so they were like, our headquarters is across the street. Like, sure, like we'll buy the credits, And so it's hard to do because of the duration. So, Congress has passed, I mentioned, like other tax credit types to incentivize behavior. So you have solar energy credits, you have historic credits that have a 5-year, you have new markets tax credits, which finance different things, but they have a little bit of a shorter duration. You don't need to be in the deals for 15 years. You can be in them for 5 or even 1 in the case of solar credits. And so that's made my job a lot harder selling mostly affordable housing because, energy guys can call and be like, hey, you can do a 1-year credit and get a 30% return versus a 10% return over 15 years. Like that tends to be a lot more attractive. And so that's made it really hard to call on like big Fortune 500s. So we typically have better luck with like banks, bringing new banks into the space. And then occasionally if we can make that connection like we did with Sherwin or the steel company, like we end up having some success there.
Wow.
Thank you.
All right. Thank you, Kira. I am going to ask one more question just because I ask it every time, and then I can turn it over for any additional questions from the group. Books, podcasts, recommendations. What do you think? What are you listening to, or what do you recommend?
Yeah, so I loved the book from like a business perspective. I love the book Shoe Dog. It's Phil Knight's biography, the founder of Nike. It is fascinating. You should read it. It kind of just talks about like when Nike was a startup and how he went to a Vegas casino and like bet payroll to make payroll. I mean, it's just wild to me. I think there's a lot of lessons. I also really liked Bob Iger's memoir, A Ride of a Lifetime. Bob Iger, the chairman of Disney. That was super fascinating. I think it gives you a really good insight on, what running a big company is like. So I would recommend both of those.
Amazing. Love it. All right, Becky, I'm gonna pin you again.
Thanks. Julie, you've given such amazing information. It's fascinating to me. I have a question. I am also a crew member as a Goldie alum, and I am on the programming committee, and we're organizing a program we do for a year here downtown Chicago, and we're going to be doing one on affordable housing in June. But my question's because we've decided we really want to focus on the missing middle, right? Like not the 30% AMI, not even, 60, preferably really that missing middle. So I wanted to first clarify, LIHTC cannot be used for sale, right? It's exclusively for rentals. And is that true? Or can it be used for sale?
Yes, although there are some QAPs that allow like a rent to own type program where then, it gives the tenants availability after the credit period to purchase their units. So we've seen some deals that have that rent to own concept, But in
Okay,
general, you're correct. It's rental
just
housing.
right. Okay, so that said, as we're trying to build out the panel for this discussion, the question really is, how are you seeing, or are you seeing any of these deals being done really? And we're talking about, people really want to hear about, right, this missing middle piece, right? People make too much to
Mhm.
really qualify for some of these subsidies. They don't make
Mhm.
enough to buy the $1 million home. Where, where are people going, whether it be in Chicago in a CBD, or even, outside. I was on a call last night with Jean Peck.
Mm.
Kelsey, you know her. She's amazing. Picking her brain, and it's tough, right? Tough to find where that's really being done. And so I was curious if you're financing any of those, or where you're seeing that done, or if you're like, no, that's not going to get
Mhm.
done.
Yeah, so I sit on a board of a lobbying agency that lobbies for tax reform to advance affordable and workforce housing. Ron Wyden, who's the chairman of Senate Finance, is one of the senators that we support the most through this initiative. He's very supportive of the LIHTC credit, but he's also very focused on the creation of a MyTech credit, a middle income tax credit. In that case, it would still be rental housing, but the income bands would be, much higher up. So it would be, 140% of the area median income to capture kind of nurses, firefighters,
Right.
teachers, those types of families that, are really struggling at this point. I mean, the problem is that you can't create a monetizable tax credit. And this is what members of Congress do not understand about basic economics, is like, you can't create a tax credit for every social problem that you want to fix, because eventually, like, they only work if somebody will buy those, and they're only work for the taxpayer if whoever's buying them is buying them at, a price that is, not 50 cents on the dollar, which is what it ends up being, because then us as taxpayers are paying too much, to give up that tax revenue. I think the best way to approach helping middle income families is through maybe refundable tax credits that happen personally. Maybe if you said, hey, you can qualify for a HUD loan at a higher income band with 3% down, and we would give you a refundable tax credit for your down payment or something like that, or incentivizing banks to make, like waiving down payment requirements, things like that, or some sort of tax incentive that's more direct to the consumer or direct to the taxpayer, rather than creating this kind of rental scheme. I think that's the better way to do it. But I know it is something that everybody is really focused on. And I personally would like to see. I recently structured an investment, not recently, within the last 5 years, have structured an investment in Indianapolis that I cared about, which was like, hey, let's find a way to buy up all these vacant homes in and around downtown Indianapolis, and then renovate them and then sell them to kind of not low income, but like price them at $200,000 to $400,000 for a single family home, rather than, $800,000. And it did not do well. That investment did not do well. I think we lost money on it. So it's really hard because it's challenging. You can't, fair housing laws restrict, like, you can't say, hey, I really want this home that's $400,000 to go to a firefighter and not a Salesforce executive. Well, like, you can't do that. You have to sell to whoever gives it. So it's really hard. I think there's a better way to do it through incentivizing banks to extend financing to those middle income band, and then finding a way to refund down payments or something similar.
Interesting. Excellent. Thank you for that. I have a second question, something sort of different. In addition to having been involved with the crew thing, I've been talking to developers here who are looking to do affordable housing for individuals with disabilities. So these are people who, whether it be a physical disability, right, vets, or mental disabilities. And the big question is, how do we supply housing for these folks? They either they receive their Social Security disability, they have a Section 8 voucher, right? And then the building is built, right, ADA compliant for them, set up for whatever that is. But these are smaller projects. And to your point that you were discussing earlier, high barrier to entry for women, minority, or new developers, but it's a desperately needed class of real estate. Can you use LIHTC credits for those?
Mhm.
What is the minimum dollar amount that you see a project has to be in order for it to be financed and to be viable? And based on the discussion you were saying earlier about, the supply and demand, how are you seeing those projects approached?
Yeah, so I've done a couple of these. We've done them for intellectually disabled. We've done them for physically disabled. In both situations, they were mixed income deals. And so that was the way that the sources and uses could balance. It was like a 200 unit project in which 40 units were set aside for intellectually or physically disabled persons. They were had Section 8 financing on them to kind of help that. And then the project was kind of bolstered because it's really expensive, right, to construct everything. So you kind of need economies of scale to make it work. And so the way they made it work was then do, 160 units as market rate, unrestricted, 40 as set aside for intellectually and physically disabled. And that worked. But I will tell you, it was really hard to find investors to do it. I mean, we had to scrape and claw all the local banks to say, don't you want to see this in our community? And that was how we got it done. It's very hard to do it if you're new. And to the space. And so my recommendation there is find an affordable developer that is big. And I can give you some names. Hispanic Housing Development Corp is a big client of mine. The gentleman that runs that now used to run the investment platform at CIBC. So he knows what he's doing, but partner with them. And they could, layer in units and supportive services and some of those things to get it. But I would recommend, a larger scale project in which maybe only a portion of units are set aside, and then the others can kind of help bolster, the debt financing that's going to need to supplement that project.
Got it. Thank you. I appreciate that.
Awesome questions, Becky, and ending right on time. If you have additional questions, I'm sure Julie would be willing to chat with you all offline, but thank you so much, Julie, for your just wealth and depth of knowledge and making it very easy and digestible, I think, for everybody here. So thank you.
Awesome. Thanks for having me. Reach out with anything, and it was nice to meet all of you.
Thank
Thanks,
you.
Kelsey.
Have a good day.
Bye,
Bye-bye.
everybody.